What do you make of the move in gas today? It is a big move to the downside. Is this a blip or the start of a sustainable trend?
Well, look, there's one saying in commodities that goes along the way of high prices. The cure for high prices is high prices. So when prices do spike like this, you get reactions. You mentioned yourself, there's LNG cargoes going into Europe. You're probably also going to get some demand destruction in the process. A lot of the European industrial players I've spoken to for the last few months have been trying to curtail their natural gas consumption pretty aggressively because of these prices. Nothing really makes sense and puts them at a competitive disadvantage. But Europe still needs to get through the winter. So it's still a concern. We have pretty low inventories, and when inventories are at this low levels, you get this extreme price moves, and hopefully this last jump in prices will cure the challenges that Europe has faced and move us into a more stable price environment into the first quarter. But Europe's not out of the woods yet by any means.
So open up your crystal ball here and start to draw out what the situation will look like over the next month or two.
So I think for the next month or two, we're still going to experience extremely high volatility in natural gas prices, global natural gas prices. The U.S. is different, though. In the U.S., we're getting a supply response mainly from producers in the Haynesville and other parts of the country. We've seen a 2 BCF a day increase in production between November and October. We are also likely expecting to see more production coming through in December. So the U.S. shale industry is responding to the higher prices in the U.S. But again, Europe doesn't have that lever. Needs to experience a very high price so that the LNG cargoes make it over there. So that's where we are. So I think high volatility is going to be the name of the game for gas. But then going into the summer, I still see very high prices in Europe because, again, we've disinvested a lot in domestic production across the European region and become too reliant on LNG and Russia. That's the other part of the story.
So, Francisco, what does next winter look like? And the reason I ask about this is there is this kind of expectation that inflation is going to fall as we work our way through next year. But if you see a repeat performance of what we're seeing here in Europe this year, next year, maybe we need to call that into question. We also need to call into question the growth impulse that we're going to see in Europe next year. As you say, industrials are having to maybe change their thinking around their energy consumption.
Right. You know, we do believe that Europe is pretty much in an industrial recession right now with this kind of prices. You're looking at $250 a barrel of oil equivalent in terms of the costs per MMBTU of gas in the region. So it's really unaffordable. We're looking at potentially energy consumption being 2 or 3 percentage points higher as a share of income in Europe than it was back at the heights of the European sovereign debt crisis. And also when oil was back at $147 a barrel. So again, it's all driven by gas and power. So Europe is in a tough spot. I think European politicians are starting to realize that this cannot go on. Remember, it's not just gas, it's also carbon emission prices. They've hit record levels. And that's a tax that power generators have to pay. It's a tax that many industries in Europe have to pay as well. So I think we're running before we can walk when it comes to the energy transition. And we've disinvested from hydrocarbons a little too fast here. And maybe that's why we are now experiencing this incredible volatility. Our fear is that some of this pressure we're seeing on gas start to feed all the way into oil. That, in my mind, would be the danger scenario for 2022. And you mentioned Omicron now looks like less of a risk. If that is the case, and we all start traveling again in 2022, as we did pre-COVID, we're going to have a bottleneck. We are not going to have probably enough oil to make all that happen. So there's a risk oil spikes next year if Omicron just hits us fast and furious, and we go back in February, March to a travel patterns pre-pandemic. So that's what I'm worried about, really.
It's a fascinating projection on oil, and I'm wondering how high you actually think it can go and what that means for all the inflation watchers out there.
That's a great question. So we have $85 a barrel on Brent as a forecast for next year, and $82 a barrel on WTI. This is our average forecast for the year. Again, compare that to our more bearish outlook on the U.S. natural gas market, where we see supply responding quickly to the higher prices. But importantly, the key thing here, and we suspended our target. We had a target of $120 a barrel by the summer of next year. We suspended in the early stages of the Omicron development because we didn't really quite know how big a factor Omicron was going to be. But if the news are indeed confirmed that Omicron is going to be, as I said before, fast and furious, not going to be as dangerous, that could end up being quite bullish for oil next year as the world gets back on track and everyone gets back to travel. So that's the one thing we're really watching carefully. We're going to have an oil problem next year. And for inflation watchers, well, that's challenging. Yeah, go ahead.
Yeah, no kidding. Francisco, listed shale producers in the United States, very disciplined this year, very disciplined next year. This strikes me as being the kind of the swing factor in 2022. I'm not sure how much spare capacity that OPEC really has. US shale's got a lot of spare capacity. It's just got to decide to use it.
Yes and no. I think, first of all, if you look at the returns that the industry has delivered in the last 5 years, I think the return on capital employed has been zero. The return on capital employed for the last 10 years has been 5%. There is a reason why energy has been the worst performing sector of the S&P in the last 6 or 7 years, right? And even if you go back in time, you're also going to find energy has been the worst performing sector. Investors are tired of CEOs and management teams in the energy names just dropping money into the ground. They want them to produce returns. So the past history is a drag on returns. The bigger challenge is the future. And the future here entails the energy transition. Do we want to have a future without oil? And if we do, then why should companies invest right now? Because there's maybe a shortage of oil for a few months before we all move to electric vehicles. This is where the energy transition is creating frictions. And as you know, when you have the past and the future being hurdles to investment, things can get quite volatile in the energy space across the board, not just in gas. Because remember, I mentioned low inventories in gas, but inventories in oil are also very low, and we've been drawing at a rate of 10+ million barrels a week forever. Inventories have come down in a straight line around the world, partly managed by OPEC. But now we're getting to a point where Russia maybe has 3 more months of spare capacity, where Saudi Arabia, yes, they have an extra 1 million barrels a day, but things are starting to get a little tight. So we may have to call on shale. And I think we heard Scott Sheffield, the CEO of Pioneer, saying that he hasn't had the call from the U.S. government yet. So we'll see if that comes through.
Yeah, and obviously with the Christmas season, forgive me for the jokes. Plenty of coal going around this year, I'm sure. With the energy transition, Francisco, I'm wondering what you think will be the best bet for investors into next year.
Right. So I think if indeed the news we're hearing on Omicron do get confirmed, that we are starting to get towards the end of this pandemic, again, I think we're all hoping that this is the case, because we're all tired of doing this remotely for so long. But I think the concern I have here is that we have a tight situation in oil markets next year, and the prices do spike. But remember, one thing that could happen that may delay the upsurge in energy prices, and we like oil as a bull market. We like copper. We like the industrial metals generally as enablers of the energy transition. And the one thing I'm worried about is China, because China doesn't have any natural immunity to Omicron or to coronaviruses generally, and to COVID-19. And China also has vaccinated people with non-mRNA vaccines, and the vaccine escape is higher in that case. So it could be the case that China, with its zero COVID tolerance situation, might have struggled to manage 2022 from a transportation standpoint. Remember, China is the #2 consumer of oil in the world, and is the #1 oil importer by a long shot. So that's the one thing I'm a little concerned, that we might not see the bull market in oil that we have in the cards here. So that's what I'm watching carefully right now to confirm our bull trend in oil. And as I said, I think the metals will continue to perform well. as they relate to the energy transition. Aluminum, nickel, copper, I would be buyers of those metals selectively on dips.